ETH has reclaimed the $3,150 mark, the first time since February 1st. Its performance is now distinctly outpacing Bitcoin. While BTC slipped to around $116,500 this past Tuesday, it demonstrated a steady ascent, setting a fresh weekly high near $3,200. Among factors propelling ETH upward is a potential shift in capital from BTC to altcoins. Swissblock analysis reveals that in the previous 4 Bitcoin cycles, each BTC rally spanned about 15 to 30 days. Now, on day 12 of the current surge, profit-taking pressure could be building, potentially sparking rotation of capital toward altcoin assets like ETH. This rotation is reflected in the ETH BTC daily chart, which recently broke above its accumulation structure, a level unseen since May 24th, hinting at trend reversal. The pair also cleared its 200-day moving average for the first time in a year, a powerful technical signal supporting the medium to long-term bullish case for Ether. Veteran analyst Ted Pillows has highlighted a bullish divergence on the weekly relative strength index of ETH BTC. The RSI just broke a 3-year downtrend. It's a notable technical development indicative of a strong recovery. Meanwhile, a golden cross may be forming as the shorter-term EMA crosses above the longer-term, reinforcing the potential structural shift. Simultaneously, Bitcoin dominance is weakening, a classic precursor to altcoin season's positioning. Ethereum to lead the next wave of growth as investor focus shifts away from BTC to promising alternatives. Fractal analyst Merlion, the trader, recently drew an intriguing comparison between Ether's current trajectory and Bitcoin's 2018 to 2021 cycle. His fractal model suggests ETH may be entering a phase analogous to BTC's explosive bull run, potentially delivering returns up to 1,110%, pushing the price into the $18,205 range. The fractal scenario hinges on a 63% correction followed by a 342% surge, historical echoes of BTC's prior cycle. ETH has already doubled since Q2, lending some credence to this view. However, fractal models remain speculative. They lack rigorous empirical backing, and their interpretation is highly subjective. While price patterns may echo past cycles, using them for predictive certainty is risky. Investors must maintain perspective even as hope builds around this lens. From a technical standpoint, Analyst Daan Crypto suggests that $4,000 is ETH's next logical target after a decisive breakout into the upper half of an 18-month accumulation zone. On the X platform, Daan stated, ETH has moved into the upper half of its multi-cycle range. On a long-term view, there are only 2 key levels that matter: $2,800 and $4,000. Everything else is noise. That quote highlights the importance of holding above $2,800 as a springboard, while $4,000 becomes the next major resistance. Support around $3,150 holds through short-term volatility. ETH may consolidate above its breakout point before attempting higher targets. But if BTC experiences a pullback due to macro shocks such as rising yields or global risk-off events, ETH could slide toward $2,800 or lower, especially if large holders use dips to reduce leverage. Still, aside from fractals and technicals, network fundamentals lay a foundation for potential upside. Bitcoin's dominance remains under pressure, suggesting capital might migrate to altcoins. Meanwhile, Ethereum has improved its scaling, notably through upgrades like Pectra and Layer 2, growth factors that enhance usability, lower gas fees, and promote broader adoption across DeFi, NFTs, and other on-chain applications. Rising transaction activity strengthens ETH's narrative as a multi-utility asset, especially compared to Bitcoin's singular narrative as digital gold. Should the Fed's monetary outlook remain dovish, liquidity will likely flow into macro assets, including Ethereum, which may benefit from risk-on behavior more than BTC. On-chain accumulation data, while still emerging, provides impetus. Wallets that have been inactive are increasingly moving ETH into cold storage and the investor structure seems to be shifting from short-term speculation to long-term positioning. If ETH indeed breaks decisively above $3,200 and sustains new highs, technical momentum could snowball into a self-reinforcing trend. But this comes with inherent risk. The Fractal's upside target of $18,205 is mathematically compelling yet psychologically extreme. It implies ETH would need to leap fivefold from current levels. Even strong bull runs typically feature periods of extended consolidation, corrections, and profit-taking. Over-reliance on price patterns may blind traders to macro headwinds. Macro uncertainties are significant here. An unexpectedly hawkish CPI or PCE print could halt the altcoin move in its tracks, triggering a broader market rotation from crypto to traditional assets. Despite strong Ethereum fundamentals, no altcoin can fully decouple from macroeconomic pressures. Volatility spikes, whether from equity sell-offs, bond yields, or regulatory actions, could cascade reactively across digital assets, wiping out gains, especially for speculative models like the Fractal. Furthermore, regulatory scrutiny of Ethereum's infrastructure, particularly regarding DeFi and staking, may introduce uncertainty that stalls retail and institutional inflows. Risk management becomes critical. Using scaled entries at $3,150, $3,200 and setting stop losses just below $3,000 could protect capital if the breakout fails. Traders might consider option strategies such as long call spreads with a strike near $4,000, allowing limited downside exposure while maintaining upside play. Meanwhile, monitoring capital flows between stablecoins, Layer 2 networks, and competing chains, for example, Solana or Avalanche, is essential. Ethereum's market share may come under pressure if other chains offer lower fees or faster throughput. Institutional interest adds another layer. Coverage from firms like Grayscale, Fidelity, and other asset managers is increasing. If Ethereum starts drawing between 15 to 25% of crypto AUM as Bitcoin has, it could anchor stronger long-term demand. However, unlike Bitcoin, ETH's regulatory classification remains ambiguous. Its staking features have sparked debate, and companies investing in ETH face greater regulatory uncertainty. That means institutional adoption may lag, capping how much upside institutional flows can generate in weighing the opportunity. The key question is whether ETH can sustain above $3,200 and begin targeting $4,000 without prematurely exhausting momentum. A successful hold above breakout levels would reinforce bullish technical conviction, setting the stage for longer-term targets. On the other hand, failure to sustain, especially if accompanied by negative macro data or on-chain outflows, could slide Ethereum back toward $2,800 or even lower consolidation zones. This would undermine fractal optimism and technical forecasts, potentially resetting expectations for a protracted sideways period. Ultimately, the case for ETH's breakout and exponential upside hinges on multiple aligned assets, ongoing macro liquidity, fluid capital rotation from BTC, scaling enhancements, on-chain and large-scale accumulation by institutional and retail participants. If these catalysts align and Ethereum maintains structural strength above $3,200, the path to $4,000 appears both plausible and validated by historical patterns. At the distance to a 1,100% move toward $18,000 demands not just patience, but unwavering resilience across quarters and cycles. Investors must treat such targets as aspirational ceilings rather than imminent milestones. In the final analysis, Ethereum's advance above $3,150 is a powerful signal. It says accumulation is real and technical shifts are unfolding, but with lofty upside targets comes equally high exposure to market corrections, regulatory surprise, and macro disappointment. The next 30 to 60 days will determine whether ETH simply enjoys a robust rally toward $4,000 or attempts the ambitious fractal climb toward $18,000. As with any high-conviction trade, the best strategy may lie in balancing ambition with prudence, remaining agile to both opportunity and vulnerability.